Hi, everyone. Welcome to the latest Carson's Glass Half Full. As always, I'm Ryan, and Sonu is here. Sonu, we've had some really incredible moves in a lot of the high-flying tech stocks, and a lot of people are wondering, is this 1999 again? And I'll set the stage and turn to you in a second. For the older investors, you probably hear 99 and have certain things to think about. But for you younger folks out there, 99 was an incredible end of an amazing rally, almost a 20-year bull market. The Nasdaq virtually doubled. Technology stocks were soaring into March of 2000, and then a crash happened. Most of those high flyers are down over 80 to 90%. In fact, a lot of them don't exist anymore. The Nasdaq, the tech heavy Nasdaq, was down, I think, 82 or 83% from the peak in 2000 to the ultimate lows, I think October 2002. Bottom line, Sonu, are we in 99 again? What's going on out there?
I mean, if you just look at the price increases, you think we are
Hmm.
because, or especially over the last 5 weeks. But technology stocks have done well longer than 5 weeks over the last year, year and a half. You could argue ever
Oh, yeah.
since ChatGPT came out, and I think that was late night 2022.
Hmm.
Since then, technology stocks have been on a roll. Of course, that was also coinciding with the end of the bear market in October of 2022. Since then, we've been off to the races, right?
Hmm.
Now, when you have a big recovery from a bear market, you want, as you've said, leaders to lead. And what's the largest part of the S&P 500, for example? It's technology stocks. Technology stocks have led. There's been a reason for it leading, which is we are having this enormous wave of AI related capital expenditures.
Hmm.
And just to put it simply, one company's spending is another company's revenue and profits.
Yeah.
And that's what's driving stock prices higher. It's not just now in 99, a small difference was yes, there were profitable companies, but there were tons of unprofitable companies too. This time, the leaders are really leading, especially on the infrastructure side, and it's coming in the back of profits, Ryan.
Exactly. And we discussed the AI wave last week on the Glass Half Full. So go read or go listen to that one for a little more data. Just please note, not a recommendation. It's going to read some returns. Sonu year to date. The semiconductor index is up like 57% year to date. Intel's up over 200%. Akamai is up 77%. AMD was up 26% last week, up over 100% for the year. SanDisk up 467%. I could keep going. Western Digital up 175%, and Micron up 137%. And then the NASDAQ 100, the QQQ, as of 2 days ago, was up 27% in 28 days. Okay. I mean, so that, listen, these moves, hopefully you've been in some of them, been in some technology. Even if you have a nice diversified basket of stocks in the US, you have a lot of technology because there's a lot of technology out
Sure.
there. It's a group, Sonu, that let's say 7 weeks ago was getting beat up. Everybody's talking, is AI for real? Is AI a bubble? We were talking about a bubble in AI 7 weeks ago, okay? Because it wasn't really working. Now, obviously, it has worked because it's come soaring back. I guess that's why. Let's talk about portfolios for a second. I mean, that's why you want to. I don't know. I guess I'll say this: kind of keep some of the laggards sometimes because tech was a laggard. I mean, near term, it was a
Yeah.
laggard 6 or 7 weeks ago. And I look right now. I look at financials. Financials are really weak right now. There's still solid earnings. The economy, the consumer might do a little bit better. To me, that's why maybe you still want to own some financials because this is stuff down here. Maybe tech takes a break. Okay, that wouldn't be the end of the world with those numbers I just mentioned. Maybe something like technology, something like industrials, some other parts of the kind of the cyclical area of the economy take back that baton. Last comment, Sooner than you. I've done this for 27 years now, give or take, and I've seen it time and time again where clients want to buy stuff when it's way up here and sell stuff when it's way down there. And the bottom line, as we've talked a lot on these in this video series, we make really bad decisions at the worst possible time. So again, as great as tech is doing right now, maybe don't go all in. As bad as financials are doing, maybe consider, you know what? There's some good companies that are cheaper. How do you look at this from a portfolio point of view for all the clients listening?
I mean, you want to diversify, you want to ride that wave, as
Mhm.
our outlook for the year was called, but you want to be careful about a wipeout. And this is where you don't have to just think about the US. You can go outside the
Mm.
US. You don't just need
Yep.
US stocks. You can go global. But you need to know what you own. Because if we go to emerging markets, which are doing really well, emerging markets up, I think, over 20% year to
Yeah.
date, that's also a technology story. So be careful when you diversify as well. The South Korean index, MSCI South Korea index, is up 84%. It's year to date. The S&P 500 is up 8%. The Taiwan index, MSCI Taiwan index, is up 48% year to date.
Wow.
That's also a chip story there, semiconductor story there. right? So be
Mhm.
careful when you diversify. You got to know what you own, right? But there is more than South Korea and Taiwan in the global, market, right? As
Mm.
a global bull market. And then going to your point about diversifying within sectors, right?
Mhm.
Hey, we're in an inflationary growth period. You want companies that probably make stuff. You mentioned
Yep.
industrials,
Yeah.
energy, materials. We mentioned earnings estimates going up. That's being driven by, yes, tech, but it's also being driven by energy companies. It's been obviously because of the Middle East crisis and oil prices going up, but that's a
Mhm.
diversifier, right? We've seen that when oil goes up, stocks go down. When stocks go up, oil goes down. Now it's not like it probably worked as a better diversifier than bonds at this point over the last
Oh, yeah.
couple of months or so, right? And in an inflationary growth environment, I think you need to diversify your portfolios where you have exposure to things like commodities, managed futures, not just bonds. Bonds may not diversify as well, and I think that's a big difference, Ryan, than
Mm.
relative to 1999. Nominal GDP growth in 99, 98, 98, 97, 99 was clocking at 6%. That's
Okay.
where we are at right now, except back in 97, 99, a lot of it was real growth. You adjust for inflation, and real GDP growth was about 3 to 4%. Now, if you adjust for inflation, you're at about 2%. So
Hmm.
most of the growth is coming from inflation. But like I said, one person's inflation is another company's margin expansion and higher profits, right? And that's essentially why we're seeing the stock market do as well as it is doing.
Oh, great point. Just a couple concepts in my head as you were talking there. I mean, it's a global bull market. Hopefully, you've heard us talk about that before. I guess we didn't really have this video series, but I know a lot of people followed what our team was doing back in 23 and 24. We liked the U.S. a lot back then. Not to say we didn't own some international. We said, listen, the U.S. is going to do better than everybody else. That's where you want to be. That worked out great. Probably about the first quarter of last year, we started changing our tune a little bit, saying, listen, maybe look around the globe, look for opportunities around the globe. And the US gained, 18% total return last year. Pretty darn good. That's actually one of the worst performing stock markets. We're not complaining. And then you fast forward to this year, like you just said, most developed international. So think like Japan and Europe and Australia, a place like that. They're outperforming the US this year, and EM's doing even better. Now, I don't know. Call me again a glass half full person, name of this series. Maybe the US does a little bit better the second half of this year, plays catch up. But the reality, this is a global bull market. You could own a lot of different things. And then I hope you kind of sleep at night when we have this drama. So, no, one more thing for me, then maybe you can finish this home or add to this. One other thing I think about 99, I was there. That's when I got the bug, right? Markets going up. I remember day trading and buying just junk. Literally, I was young. I didn't know. I was young. You live and learn. Buying junk, and then it all crashed, right? And then you realize after the fact, a lot of things were happening. Well, I think the biggest thing about then and now, besides the fact, yeah, these stocks, all those stocks I just listed, up a lot. I don't have their data off the top of my head, but their earnings have exploded higher. Their revenues have exploded higher. Their margins have stayed AMD's margins are still off the charts, even with those moves I just said. So the reality is these companies, I think in a lot of ways are justifying it. Listen, is the NASDAQ 100 up, like I just mentioned, what did I say? 27% in 28 days? Yeah. It's due for probably a little pause, maybe even a well-deserved break. Let's be honest. But the reality, the underlying pinnings to why we're here are earnings. And that justifies where we are, I think, with technology and why we think, a year from now, I think tech will still do pretty good. Maybe 3 months from now, listen, maybe it's due for a break. But a year from now, I still think tech is something you want to definitely own. Or should I say, ride the wave? Sonu, bring us home on this one.
No, this is where you want to be probably tilted. You don't want to close your eyes to what's happening in the world around us. This is one of those times, I think, what you're seeing in the macro economy, a lot of capital expenditures, what I'm seeing in GDP data, things like that, is also translating to the stock market. It all
Yep.
aligns. But at the same time, you don't want to be overly concentrated to that because then you can get wiped out. But a good example is look at the Dow. The Dow hit 50,000 a few months ago. It
Yeah.
struggled to regain that,
Yeah.
right? So it's a lot of Dow versus the Nasdaq. You don't want to put all your marbles in the Nasdaq bucket there. Maybe you want to diversify with the Dow. Maybe you want to diversify outside the U.S. as well.
No, well said. Yogi Berra, famous Yankees Hall of Fame catcher, said it's deja vu all over again. So is it deja vu all over again with 99? There are some similarities. I must be honest. There are some clear similarities, but we do not think we're in a 1999 scenario. We still think this is a bull market, and tech will probably still do pretty well as we look out into the long run. So everybody, again, this is your latest Carson's Glass Half Full. We'll see you next week. Thank you. Take care.